Nations do not collapse overnight. They accumulate obligations. Debt is not inherently dangerous. In fact, it is one of the most powerful tools in modern economics. Governments borrow to finance infrastructure, stimulate growth during recessions, fund social programs, and respond to crises. When managed responsibly, debt supports long-term development. It allows economies to smooth shocks and invest in the future. But when borrowing becomes structural rather than strategic, something changes. A sovereign debt trap forms when a government's outstanding obligations grow faster than its economic capacity to sustain them. The ratio of debt to GDP rises steadily. Interest payments consume a larger share of public revenue. Fiscal flexibility narrows, and gradually, policy decisions begin revolving around one objective: maintaining access to borrowing. The trap does not spring suddenly. It tightens quietly. In the early stages, rising debt may seem manageable. Interest rates are low. Investors remain confident. Global capital seeks yield. Governments refinance maturing bonds without difficulty. Deficits persist, but markets tolerate them. The system appears stable. However, stability depends on a crucial assumption: that economic growth will outpace or at least match the growth of debt. Growth expands the tax base. It increases income and productivity. It allows governments to service obligations without imposing excessive burdens. But when growth slows, due to demographic decline, productivity stagnation, geopolitical fragmentation, or financial crises, the equation shifts. Debt continues compounding. Revenue growth slows. Fiscal gaps widen. At this stage, governments face limited options. They can cut spending, raise taxes, borrow more, or rely on monetary intervention. Each option carries consequences. Spending cuts may trigger political resistance and economic contraction. Tax increases may discourage investment and reduce competitiveness. Additional borrowing increases vulnerability to interest rate shifts. Monetary accommodation may weaken currency stability. The most dangerous moment arrives when interest rates rise meaningfully. In a highly indebted system, even modest rate increases can dramatically raise refinancing costs. Bonds issued years earlier at low yields mature and must be replaced with higher-yielding debt. Interest expenses expand rapidly. Budget deficits widen further, not because of new spending, but because servicing old obligations becomes more expensive. Markets notice. Investors begin demanding higher yields to compensate for perceived risk. Rating agencies reassess creditworthiness. Long-term borrowing costs climb. The debt burden accelerates, creating a feedback loop. Higher yields increase deficits. Larger deficits increase debt issuance. Greater issuance pressures yields higher still. This is the essence of the sovereign debt trap. Borrowing to service borrowing. In extreme cases, governments may attempt fiscal consolidation. They cut expenditures and implement austerity measures. While intended to restore confidence, austerity can suppress growth in the short term. Reducing tax revenue and worsening debt ratios temporarily. Social unrest may rise. Political instability may increase. Reform efforts may stall. Alternatively, governments may rely on central banks to absorb debt through asset purchases. Large-scale bond buying can temporarily suppress yields and stabilize markets. However, this approach carries its own risks. If investors perceive that debt is effectively being monetized, concerns about inflation and currency stability intensify. Confidence, once again, becomes the critical variable. The trap deepens further when external debt is involved. If a significant portion of sovereign debt is denominated in foreign currency, depreciation increases the real burden of repayment. Currency weakness amplifies fiscal stress. Governments may be forced to raise rates to defend their currency, further increasing domestic debt servicing costs. Modern sovereign debt dynamics are complicated by global interconnectedness. Large economies influence global capital flows. When major central banks tighten policy, global liquidity conditions shift. Borrowing costs rise not just domestically but worldwide. Countries with fragile fiscal positions may experience sudden stress as refinancing conditions deteriorate simultaneously across markets. Importantly, sovereign debt traps are not purely economic phenomena. They are political. Fiscal discipline requires long-term planning. Electoral cycles incentivize short-term spending promises. Structural reforms often face resistance. The path of least resistance frequently involves continued borrowing, especially when markets remain temporarily forgiving. Demographics compound the challenge. Aging populations increase entitlement spending, while shrinking the workforce base that supports tax revenue. Healthcare costs rise. Pension obligations expand. Without productivity gains or policy reform, debt ratios trend upward over decades. The psychological dimension cannot be overstated. As long as investors believe a government will honor its obligations, without resorting to inflationary financing or restructuring, confidence holds. But when doubt emerges about fiscal discipline, growth potential, or political stability, repricing can be swift. Sovereign bonds, once considered safe assets, may experience volatility. Financial institutions holding large quantities of government debt may face balance sheet strain. The consequences extend beyond government budgets. Sovereign bonds underpin the global financial system. They serve as collateral in funding markets. They anchor interest rate benchmarks. They shape corporate borrowing costs. When sovereign risk increases, the ripple effects spread across banks, corporations, and households. Breaking free from a sovereign debt trap requires credible alignment between fiscal and monetary policy. Sustainable reforms must demonstrate commitment to stabilizing debt trajectories. Economic growth strategies must enhance productivity and competitiveness. Inflation must remain anchored. Communication must restore trust. History shows that outcomes vary. Some countries implement painful but effective reforms, stabilizing debt over time. Others experience prolonged stagnation, elevated borrowing costs, or currency instability. In rare cases, restructuring or default becomes unavoidable. In the modern era, debt levels across many advanced economies have reached historically elevated levels relative to GDP. Low interest rate environments masked vulnerabilities for years. But as global rates normalize and geopolitical uncertainty rises, sustainability questions grow louder. The sovereign debt trap is not a dramatic explosion. It is a tightening constraint. It narrows policy flexibility, it increases vulnerability to shocks, it amplifies the consequences of miscalculation, and it forces governments into difficult trade-offs between growth, stability, and credibility. Debt can build nations, but unmanaged debt can slowly corner them. And when a government's primary objective becomes maintaining market access rather than investing in its future, the trap is already in place. Welcome to Cash and Chronicles, where money, power, and history collide.